Hey, how's everyone? Excuse me. How's everyone doing today? If you can, give me a check, audio check for you guys if it's coming in okay. Good to see you all. Danny Westbrook, yes. Giddy up, always be funding. How you doing? Ralph Steiner, John Pablo Pena, how you doing? Polynesian Pit, how you doing? All right, thanks for the heads up. So I'll just gather some things together and I'll see you guys soon. Hope everything is going okay for y'all. Hello again, everyone. Welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, and this is our live stream. Glad to see a lot of you guys here. Looking at some of the comments, you can see folks got a lot of things on your mind. One of them we're going to touch on a bit. I think it was from this one here, Dan the Man. California will never stop the taxes. Yeah, I saw a tweet on that. We'll take a look at it, and it's pretty amazing what's going on there. But nonetheless, welcome aboard. Glad you folks all could make it here. Phil Pelletier, again, Dan the Man, John Roylance, Mike M, Nathan, Mark, Lane, Rossi. Glad you guys could all make it here. If it is your first time here or you haven't already done so, please do subscribe. Hit the bell to be notified on updates and give us a thumbs up if you like what we do. As always, we do appreciate your support, and you can find us, excuse me, on social media. Our website is silverbullion.com.sg, where we do have various products to help with a systemic wealth crisis. And I do hope you folks visit our website to understand how we can help you, because one surely looks to be coming in on the way. Silver Bullion SG is our Facebook page. Twitter, Silver Bullion PL, PL for Private Limited. You can find the audio versions on bit.ly, SBTV iTunes, and SBTV Spotify. And as always, do join our Crisis Tracker group, where we go ahead and we post daily news items and features as it pertains to gold, silver, economics, finance, things like that. It's a good place to get some really good information, and we do update it pretty frequently, just about every day. So we do hope that that you'll join us there on that Crisis Tracker group. So how's everyone been? How's your weekend going? Lane Rossi, you're welcome. Jim Prepper, Kareem R, Dan the Man, yes. Let's see what else is out there. Okay, Bill Clark, Ralph Steiner again, Silver Warrior, who gave a thumbs down first 3 minutes. Well, I kind of have an idea who those guys might be, but it's okay. I'll keep it to myself there. But glad again, as always, you folks could make it on. Upcoming guest, we're going to have Egon von Greyers, the founder of Matterhorn Asset Management. Reservation. So again, we do hope you'll join us for that interview or take a look at it. I think it's going to be a pretty good one. Egon always has some great things to say. He's one of the stalwarts. He definitely knows gold and silver and the market. So we're going to be glad to get him on. So we're going to try something new this week. We're going to play He Said What? And what we're going to do is we're going to give away David Morgan's ebook, Silver Manifesto. So I do hope you folks had a chance to look at the Bron Sucheki interview this past week and a little bit of guidelines to this game that we'll play. It's just a simple game. Download the Kindle app for your iPhone, for your Android phone, for your tablet. It's free. So just go ahead to whatever app store you have. Go ahead, download the Kindle app. Be the first to answer correctly in this live stream. And U.S. winners will be given a link to download the ebook. Winners from outside the U.S. will be offered an alternative prize at our discretion. The reason for that is because for some reason, Amazon Kindle, they won't let you gift an ebook outside of the U.S. So it's not us. It's those guys. So we can point the finger at them. But we'll find an alternative prize or a way to get you something. And you're going to need to provide us an email during this live stream if you don't mind. So we need to make sure that we're getting in touch with the right person that won. So do hope you'll be okay to give us an email. So with that, we'll go ahead with our first He Said What? And the question is, in last week's Bron Sucheki's interview, where did he say Australia ranks as a world's largest gold producer? So we'll look to see who comes up with the answer first. So let me scroll through here. So Australia ranks as what country as a gold producer? So let me look through here, comments real quick, see if any of you guys can get it. Hang on, just scrolling through. A lot of comments today. Okay, so again, if you watch that interview, it's a numerical number. Does Australia rank as number 1, number 2, number 3, number 4, number 5? Jeff, 3. What? Seymour Rivers, you got it right. Australia ranks as number 2. Seymour Rivers, got it right. Okay, so what we're going to do, Seymour, is we're going to need if you could post your email to us, and just to confirm that it was number 2. Here's Bron. You can hear the words from himself.
A big exporter. We obviously don't. Second largest gold producer in the world, and obviously our population's quite small, so most of our gold is exported.
Okay, so there you go. Bron said second, number 2, and first one to get that right was Seymour Rivers. So Seymour, if you don't mind, again, can you just send us your email? Just post your email here in the live chat. So yeah, we need to get that so we can go ahead and send you your ebook, David Morgan's Silver Manifesto. So we'll be looking for you, Seymour. Got to post it so we know that we're getting the book to the right guy. Okay, so moving on, and I'll be looking to see if we can find it still. Hang on, sorry about that, guys. Yeah, Seymour, you got it right. So you're gonna have to give us your email now so we can go ahead and send it to you. Okay, so moving on. I want to go ahead and take a look at our website, because silver gold price, they've been moving quite a bit lately. I think you guys know all that already. It's been pretty volatile lately. It's had some good days, it's had some off days, it's had some pretty frustrating days without a doubt. So what we'll do is we'll just go ahead and take a look at our website here, silverbullion.com.sg, and let me update it, make sure we have the most current figures. Okay, so silver in US dollars, we're looking at 26.20. So it's come down just a bit. Gold has also come down just a bit at 1936, 30 cents per ounce. So it's come down just a little. Nickel 14,000. So it was at 12,000 not that long ago. So it's up to 14,000 per ton. So nickel's doing pretty good. Investor kit here, it is free. We do hope you download it. Just click on this and you're going to be taken to a page with the PDF, so you can go ahead and take a look at it. And do sign up for our storage accounts. Frankly speaking, you never know when you're going to need it, or if you want to look into storing off sea. So it's good to have this up and ready. There's no maintenance fee, no charge to have one. It is a good idea to open up and go ahead and get this storage account. So moving on, silver gold ratio 73.9. We just saw it cracking 70 in the 69 range last week, and it's back up to 73. As I said, it is, or it has been pretty volatile. So we'll just have to wait and see. It does pose the question though, should you be buying on the dip right now, waiting for better price, or do you just simply go ahead and pick up some gold, pick up some silver, knowing that supplies are starting to tighten a bit? So let me see. Seymour Rivers, no email. You have to have a you have to have an email. How can we get this to you? Um yeah, you're gonna have to gotta figure this one out. We didn't figure this part out if somebody didn't have an email. Just assumed everybody had an email. So Seymour, we're gonna have to figure something out with you, okay? So going forward, looking at the Twitter feed, some interesting things going on with Twitter. A lot of interesting things going on at Twitter. Santiago Capital, he posed this question: who is smarter, the people who bought gold years ago in the 1,000 to 1,200 range, or the people buying now 1,800 to 2,000 range? So more than half the guys said that smarter people who are buying at 1,000 to 1,200, but I think Jaime Carrasco hit it on the head where he says both. At least they are buying and still the minority. But to answer your question, it's those buying silver. So Jaime Carrasco, I like that answer. Good answer. Seymour Rivers, okay, we'll have to figure something out. Because we're going to have to get in touch with you during this broadcast. Otherwise, if we tell you to email us, we're going to have 1,000 people telling us that they were Seymour Rivers. So we can't simply have you email us in. We're going to have to figure something out. Maybe if you have a junk email, that'd be good. A lot of people, they keep a junk email specifically for junk email. So maybe this might be a good case to have one. Alistair McLeod, Turkey hit by bank runs, currency panic as locals sell their cars and houses to buy gold while lira implodes. So this is coming from Zero Hedge. Let's see what this one is about. Okay, so yeah, we'll have to figure something out with that one, Seymour. Okay, so let's let this page load up. Turkey hit by bank runs, currency panic as locals sell their cars and houses while lira implodes. They're buying gold. It's been a miserable 5 years for Turkish citizens who have seen their purchasing power slashed by more than half, and it's only getting worse. Turkish lira has cratered against the dollar and most developed currencies, plunging from 3 TRY per dollar to a record low 7.37 last week, after a brief and valiant attempt at imposing shadow capital controls by Erdogan, who is now de facto head of the Turkish Central Bank, failed miserably at the end of July, and not even a draconian hike in overnight funding rates above 1,000% last week to crush the shorts was able to prevent a plunge in the lira to new all-time lows. As the currency, this is the interesting part though, as the currency implodes in a nation that is becoming increasingly more banana with each passing day, as Erdogan solidifies his takeover of every government institution in the process, turning off any potential foreign investors. Turks are discouraged from material purchases of dollars to hedge the collapse of their native currency due to some of the strictest capital controls on the planet, which has left them with just one option. And we spoke about capital controls before. This is a tool that comes into play whenever currencies get in trouble. As Reuters reports, Hassan Ayhan followed his wife's instructions last week and took their savings to buy gold at Istanbul's Grand Bazaar as Turks scooped up bullion worth $7 billion in just a fortnight while their currency went up in flames. Retired police officer hit by vivid memories of the 2018 currency crisis, which saw the lira rise or lose 30% of its value virtually overnight, was among those playing it safe as he queued in the city's sprawling covered market where a screen showed the gold price rise by 1 Turkish lira in just 10 minutes. So this is something that we talked about before, where capital controls do come into play. And what we're seeing in Turkey is they're getting a little bit of trouble with the currency. Guys are moving into gold. So that is something that typically happens. And then again, you have governments who try and put in types of capital controls. Sage and Food, yeah, Peter. As I mentioned in the description, this was an interview by Kitco, which we're going to take a look at. So the interview, it's already happened. We're just going to go back and take a look at it. It's not us interviewing Schiff and Rickards, which is why in the description we had put that it was from Kitco. So again, this is something we're just going to go over as a group. Okay, so let's see what else is going on with Twitter. Gold and economic freedom are inseparable. In the absence of the gold standard, there is no way to protect savings from confiscation through inflation. Gold stands, let me get this up for you guys so you can see it. Gold stands as the protector of property rights. And who said this? Alan Greenspan was the one who said this. Pretty interesting that he would say that. Let's see. Just a simple question. Is the near future one of peace and stability or chaos and uncertainty? This is from TF Metals report.
You see boards, windows are gone. Look at this. Look, no, this was not a riot. This was not a riot, right? Look at this. Look at New York City, what happened. Here's the Adidas, the Nike store. Look, Nike, Adidas, Philippines, Oakley, Barnes and Nobles. They even took books just to put it on eBay. Anything could sell, they took. Look.
Okay, so that one, I was pretty amazed when I saw that, I mean, just to see a lot of places boarded up in the heart of New York. Kind of makes you wonder what again is going on. And if any of you guys are in that area, I mean, is it really like that? It's pretty amazing to see these things, and don't necessarily mean amazing in a fascinated, positive way. It's more of in a way where you kind of wonder, as I said, really what's going on. And again, as we've talked about before, is where you live or your place, or what do you see with your country, your government? Is it headed more towards peace and stability, or does it look like it's headed a bit more towards chaos and instability? And this is one reason why, as we've said before, it is good to get that account ready. Just go ahead and open up that account with us. Again, it doesn't cost anything, because you simply never know when that time comes where you may have to move some of your assets offshore into a safer place until things settle down, and then go ahead and get them back home to you. But again, it does, it looks a bit concerning right now with what's going on. So, just stay aware. Always stay aware of things and be alert. Be alert. And Seymour, we haven't forgot about you. We're still looking for you to help us figure out a way to get you the book. So hopefully we'll get a response from you. We do want to get it to you, okay? So let's go ahead and take a look at more things on Twitter. As one of you guys mentioned, California proposed from Peter Schiff a 0.4% annual wealth tax that applies to former residents who already left within the past 10 years, and to current residents for 10 years after they leave. The rate is reduced by 10% for each year of absence. Any wealthy person who moves into California is nuts. This is coming from Peter Schiff. How does this happen? How does this happen where you can leave a state and they're still going to hook you or hold you back with an annual wealth tax for former residents who have left in they're gone for 10 years? How does that happen? How did this happen? I mean, we just saw New York, things are boarded up. California, how does this happen with the government? I mean, I'm pretty amazed to see something like this even thought of, that you can leave the country and they're still going to keep you on the hook for 10 years. It's pretty amazing. Pretty amazing. So let's see. Let me take a look at some of the comments on there. Let's see. Nicholas Nasty. Yes, it's really like that. I went to New York the other day for a doctor's appointment. It's awful. It's empty. Sad to hear that. Sad to hear that, Nick. Just keep your head up. I'm sure there's going to be brighter days coming ahead, but still, we do have to understand that there are things that we may need to do that we may not be accustomed to doing in order to prepare for a little bit of darkness before that light. But I'm sure there is going to be some light coming ahead. Okay, so let me take a look at the Twitter feed still. Just a few more articles. Jim Rickards, Buffett dumps JP Morgan, Wells Fargo, excuse me, buys Barrick Gold. One way to understand this is he's dumping companies that create paper money to buy a company that produces real money. Economists call this a liquidity preference. I call it a sign of time. So this is from Fox Business. So we'll just take a brief look at it. Okay, so we'll pull this up. Okay, I guess the internet's a bit slow today. Sorry about that. Warren Buffett sheds big stakes in banks and goes for the gold. Warren Buffett, welcome. Welcome. We've been here waiting for you. Warren Buffett's Berkshire Hathaway Incorporated unloaded more than a quarter of its stake in Wells Fargo and Company and about 61% of its position in JP Morgan Chase. That's pretty huge. 61% of its position in JP Morgan Chase, while acquiring a new position in Barrick Gold Corp, according to his 13F filings with the Securities and Exchange Commission, which was recently filed. So Berkshire's moves appeared to reflect a broad lightening of the conglomerate's exposure to large capitalization banks during the worst public health crisis in generations. Berkshire sold 85.6 million shares of Wells Fargo, representing about 26% of its stake and putting its ownership to about 3% from 5.3%. Insurance conglomerate also shed 35.5 million shares of JP Morgan, 61% of its position, which now represents 1% of Berkshire's overall portfolio from 3% in the prior period. It's pretty interesting. You got to wonder what's going on in Warren's mind, where he actually is almost cutting ties completely with Jamie Dimon and JP Morgan. 61%. Just can't get over that number. It's pretty huge. Meanwhile, the investment firm acquired nearly 21 million shares from Barrick Gold, worth $563 million, over $500 million, representing 0.3% of Berkshire's holdings. Berkshire also reduced its holding in PNC Financial Services, selling 3.85 million shares to cut its position to 0.3% from 5%. So again, 61% from JP Morgan, that's huge. I mean, we've been hearing things, JP Morgan with in the comics, there's silver in the vault, people taking delivery. We've been hearing a lot of these things going on, and then now we see Warren Buffett cutting or just limiting what he has as far as exposure with JP Morgan Chase. So that's pretty interesting. So let's take a look at some of these comments. Okay, thanks, Seymour. Appreciate that. Okay, so let's see what else is out there. Vincent, thank you as well. Appreciate that. Let's see. Comments. Some I can't say, but I'll laugh at them. You guys got some pretty good comments out there. Let's see. Can I interview Buffett about his new Barrick shares? Sure, we can try. Warren and I haven't spoken in quite a while. I think it's been about since I was born, but we'll try. We'll try to get Warren on. See what happens. That's the best we can do. Is try, right? Appreciate the comment. Okay, so let's see what else is out here in comments. See, gold's got a long way to go by the sounds of things. It does. People like to use that phrase "to the moon." It's, and in fact, when we get into Rickards and Schiff, they're going to kind of say, it does have a lot of upside. So does silver. Both silver and gold do have a lot of upside, and again, it is something. It's your hedge towards what's going on right now with the monetary system, with the Fed printing and all of these things. It's important that we understand that there are things that we can do to protect ourselves. We don't have to think that there's nothing can do, because there there are things that we can do. Okay, so moving on. Santiago Capital, what's the easiest trade between now and year end out of the following choices? Stocks going up, gold going up, rates going lower, rates going higher. Most people say gold higher. So there you go. I mean, it is getting to be the more popular opinion right now where, gold has a way to go, just as you said, and more people are going to be piling in. So this article here, Federal Reserve reveals research plans for a digital dollar, and this is something that we've often talked about, how the Fed is creating or looking at the central bank digital currency, and it's not just the Fed; it's other central banks as well. So this came out a few days ago, August 13th. Federal Reserve reveals research plans for a digital dollar, and this is something we all got to be aware of. Federal Reserve Governor Lyle Brainerd provided a broad description of the Fed's ongoing research and plans in the potential development of a U.S. central bank digital currency, CBDC for short, also described in the U.S. as a digital dollar. Brainerd, who has for years led the discussion at the Fed on distributed ledger technology and digital currencies, noted the Fed is active in conducting research and experimentation in these areas. In her speech during the Federal Reserve Innovation Office hours at the Federal Reserve Bank of San Francisco, Brainerd noted, given the dollar's important role, it is essential that the Federal Reserve remain on the frontier of research and policy development regarding CBDCs. As part of this research, central banks are exploring the potential of innovative technologies to offer a digital equivalent of cash. We are accounting to assess the opportunities and challenges of, as well as the use cases for CBDC as a complement to cash and other payment options. Now, this part was interesting because they're saying they're always looking at it. But a few weeks ago, I showed you an article from Yahoo Finance where Japan, I don't know if I'm reading this as maybe they sort of let the cat out of the bag, where the Fed is saying we're still looking at it. But here we have Japan where they're saying they're seriously considering to issue digital currencies. This came out July 15th, as noted, where Japan's government is said to be seriously considering issuing a central bank digital currency. Their largest financial newspaper reported back then, saying that the government will include the CBDC plan in its policy framework this year. The inclusion of such a plan in Japan's policy framework would make it official government policy per report. Here's the interesting part. Japan is looking to explore the possibility of using CBDC in coordination with other countries such as the U.S. and European nations per the report. So we sort of had the U.S. is saying we're still looking at it. Japan is saying, more or less it looks like they're going to move forward in coordination with U.S. and European nations. So the timing of this, are we looking at Japan's timing? Are we looking at the Fed's timing where they're saying, we're still thinking about it. Japan is saying we're going to do it, and we're going to do it with U.S. and European nations. So that is pretty you're kind of getting mixed signals between what Japan is saying and what the Fed is saying. The way I look at it. A couple more things from Twitter. Federal Reserve admits working on a new digital dollar, which is true. Christine Lagarde, former head of IMF, now she's the head of ECB. She came out with this video. I want to take a look at it. I want to get your opinion on this because it struck me as kind of odd. So I just want to see what your opinion about what she had to say is.
I would like to join is the custodian of the European Central Bank, which is the custodian of something that belongs to you, the youth of Europe. We are the custodian of the euro, which is your currency for your future. I would like to join the call for action of the United Nations to engage you in participating in the policy debate that we have. What will the future hold when it comes to monetary policy, when it comes to the price stability which defines and is the mandate of the European Central Bank? Well, what matters is The euro? Banknotes or digital currency? What matters is fiscal policy, working hand in hand with monetary policy? Yes. But how will that be managed in the future? That's your future. What about climate change, and does it impact on price stability? And does it matter for your future? All those questions are relevant and important and actually touch on or sometimes determine what we at the European Central Bank have to do to be good custodian of our common good, the euro. So please engage and participate with us in our strategy review. We have something that is called...
Okay, so that was ECB head Christine Lagarde, a former IMF head. So, I mean, I'm just kind of curious to see what your opinion was with or is with what she had to say. It can be taken in so many ways, and I'm just curious to know what your opinions about what she had to say are. Captain Ron Hayward, we are in the beginning of a civil war here. It's an all or nothing battle for both sides. I'm assuming it's obviously, this is referring to the U.S. It's a tough call, but I mean, you got to look at things for what they are right now. And there is a divide, I'm just adding comment to your question. I mean, there obviously is a divide right now, and it's almost uncanny how when you go back to that book that we talked about before, The Fourth Turning, where the younger generation rebels against the older generation. Older generation, they feel like young people don't understand things, they're too young, they don't know, they're inexperienced, this and that. But they're missing the point, because for young people, it's challenges that they have that they can't seem to overcome, and then it becomes easy for them to point the finger at older people. So, if it is some type of a civil war, as you mentioned, I think there's also an age war involved between young and old. There's obviously a political, ideological, differences that are going on as well. It seems that there's just division in almost every facet that you can cut up. There seems to be division in it. So, again, this is another reason where, it may be a good idea for you, not for everyone, but perhaps for you, where you may want to consider getting an account ready just in case you have to put some things out of reach of the government, out of reach of what's going on with riots or whatever it is, out of reach. Keep them in a safe place until things kind of calm down, and go ahead and get them back if you want, or just see the benefits of storing in a different jurisdiction, what they can do for you. So, again, if you think things are really going to start to heat up, it may be a good idea to consider different options. That's all I'm saying. So if it is in your realm of possibility, consider it, and just it doesn't matter wherever you're at. Start looking at options that you have that you can move into and protect yourself with. Okay, so just a few more items from Twitter, and then we'll take a look at what Schiff and Rickards had to say. And this one was interesting. It was something Kyle Bass had to say about COMEX. So we'll just go ahead and play this really, really quick for you guys. Okay, so we'll fire this one up.
Kyle, can you talk a little bit about gold and why at UTIMCO, why at UTIMCO you actually took delivery of the actual gold?
So I'll give you my opinion. I won't speak on behalf of UTIMCO.
Sure.
So my opinion is very simple. As a fiduciary, which I am in that position, to the extent that you own gold and you are going to own it for a long time, it's not a trade. It costs us about 90 basis points a year to roll it through financial futures contracts. And then we went and looked at the COMEX. So the COMEX at the time had about $80 billion of open interest between futures and futures options. And in the warehouse, they had 2.7 billion of deliverables. So 80 billion of open interest, 2.7 billion of deliverables. We're going to own it a long time. You're on the board. You're a fiduciary. What do you do? Like, that's an easy one. You go get it. All right. So you go take $1 billion of the 2.7 billion and let them worry about the rest. And when I talked to the head of deliveries for Comex NYMEX, I said, well, what if like 4% of the people want delivery? And he says, oh, Kyle, that never happens. You know, we rarely ever get a 1% delivery. So, and I said, well, what if it does happen? And he says, well, price will solve everything. I said, thanks, give me the gold. You know? And then what was interesting was we conducted an audit of the delivery. And what was interesting in the audit was they kind of resisted our audit request on the front end. And then they finally allowed us in. And we did a random audit we had like 1,600 bars or something like that. And we just wanted to see 20 or 30 of them. And they were all over the place in different venues in the vault. They weren't segregated. So yeah, it's an interesting concept. But what I'm saying is the exchange is a fractional reserve exchange, and they think price will solve everything. So I mean, that was the decision. It's actually an easy decision if you're a fiduciary.
Okay, so the exchange is sort of like a fractional reserve exchange. So Kyle Bass is feeling it. They don't have all the gold that they claim they have per ETFs, so or GLD, SLV, things like that. So again, if you're into those types of vehicles, just understand that the gold may not be there for you if you want to pull it out. Again, this is why people choose just to straight up go into physical and not deal with the paper trades, because a lot of times the gold or the silver, which are supposedly backing these paper trades, just aren't there. So Kyle Bass, he's laying it out. This was from about 5 years ago or so. So he had some I think they're pretty good comments. I mean, from an insider, he's helping us understand again what's going on with comics. Okay, so looking at some of these comments again. Let's see. John, Tomorrow's World YouTube for the Truth. I don't know if that's a YouTube channel or what, but I will agree that seemingly more and more, if you want to find, if you want to have a different perspective on things that may help you put things in focus or make decisions, YouTube seems to be a place that more and more people are going. So, and again, this is something, as I've said before, your comments are hugely important, because you do have people that are sitting on the fence right now trying to decide what's the best thing to do for them and for their families, and they're taking a look at your comments more than anything I'm saying. So I do hope that you have comments that can help people along, because believe me, there are many people out there who are still trying to wrap their head around what's going on, and you guys definitely hold the key to help them understand. Kyle Bass was from 2015, so it was about 5 years ago, but still, I don't think comics has changed in 5 years. So I think what he says still holds true. Okay, so let's take a look at more of the comments out there. Let's see. Okay, well, I guess you guys are doing okay with your comments there. So anyway, those are a few things that I wanted to take a look at. And one more thing, after that Christine Lagarde thing, there was an article from Thomas Manninen, who we've had on a few times, and I just want to go ahead and take a look at a recent article that he wrote, and it's pretty interesting, where the title alone, the disastrous stealth federalization of the EU, I mean, found it to be pretty significant. And Thomas, he does know ECB very, very, very well and what's going on there. So when the European Union was created in the mid-1990s, it had bold aims to unify Europe, erasing the risk of new wars, to create a common market for goods and services. I think a lot of us remember this, right? And to bring prosperity to all, and to enforce the rule of law across Europe. A vital part of this effort was to encourage sound finances among sovereign member states through mutually agreed rules and constraints. Wars among member states have fortunately been avoided, but mutual prosperity, the rule of law, and economic and political sovereignty have gradually been lost. Increasingly, the union is one of bureaucracy only, run at the federal level, and the common currency, the euro, is at the very center of these problems. So the latest and arguably most serious attempt effectively to undermine sound sovereign finances and to impose a federal-style mechanism on the EU is the Recovery Fund. So some of you heard of this and some of you have not. Its economic rationale does not hold up, and it seems like a desperate effort to bribe the problematic southern economies, especially Italy, stay in both the euro and the union. Italy has a massive sovereign debt, around 140% of GDP, and has declined funding from the European Stability Mechanism, most likely because its loans come with conditions which require economic reform. This could be too embarrassing for a G7 nation, and Italy could choose to opt out. Most worryingly, the blueprint for the Recovery Fund seems in many respects to be contrary to several important principles of the treaties as originally understood. It thus undermines the rule of law within the EU as well as its legitimacy. It also continues the failure to encourage member states to adapt their economies or to the demands of a common currency and to take responsibility for their own economic policies and development. So again, he's calling it the federalization of the EU, stealth federalization. And again, it's dangling carrots in front of people, trying to get them to take the money. You need the money. Here's the money, but you have to do what I say. You're going to follow these rules, these guidelines. And so, some countries, they don't want that. They want their sovereignty again. They want their own currency again. They don't have to opt into these things, and they're looking at opting out. So, it's going to be, again, interesting to see what's going to go on with Europe. So getting to some of these comments again. Let's see. Bill P. So, thank you, Bill. Appreciate that. It's quite a bit. I've been stacking silver since I was 17, and I'm 57 now. Thank God my grandfather clued me in on silver. It's good to hear, Bill. I mean, I tell your grandparents, they've seen it all. They know life, and I've shared the story also of my mother when I was a kid. We'd open up that piggy bank and she would tell me which pennies to look for, which quarters, which dimes and things. And it was because of things like silver and the content of those coins, which really had silver in them, especially those 64 and earlier half dollars and things like that, quarters. So, Bill, I'm glad your grandfather took you on the side and he told you about those things. Sometimes, I think that's all that needs to be done is just get with the kids, let them know what's up, show them, the reality of things and help them to understand. Got to take time out and help kids understand life more from family, perhaps maybe more than Facebook and other things. Well, it's just my opinion there, but family is important. So, Bill, it's a good story. It's a really, really good story. So, with all of that, just want to get to move on with it. So a lot of things happened last week, but I want to go back to the week prior and take a look at the Jim Rickards, Peter Schiff interview / debate from Kitco. So I want to make sure we give all credit to Kitco. But before that, I was going to show you a couple of things that Jerome Powell had said, but I think we can forego that and we'll just go ahead with the debate. So let's go ahead and start with what Peter Schiff had to say.
Joining me today is Jim Rickards, best-selling author, and Peter Schiff, CEO of Euro Pacific Capital. Gentlemen, it's an honor to have both of you together at the same time. Welcome.
Thank you.
Let's start with you, Peter. You've called for gold to hit much higher levels for quite a while. Tell me about what your initial reaction was when you first saw that 1900, 1920 level this week.
Well, I'm surprised it's actually taken this long to get here, because the last time we were in this area, it was 2011. And a lot has happened in the last decade almost. We've certainly printed a lot of money. And I think the world should now be able to figure out what should have been obvious back then, but wasn't for whatever reason. And that's that the Fed has moved into a policy from which it can never extricate itself. You know, when we went to zero, when we did QE, people initially thought it was temporary and that the Fed could normalize rates and shrink its balance sheet. And I said from the beginning that that was impossible. And I think the markets are now beginning to realize that I was right about that. And when they contemplate a future of endless money printing and 0% interest rates forever and multi-trillion-dollar deficits funded by the Fed's printing press, it's starting to sink in, and they're getting rid of their dollars and they're buying gold.
Okay, so Peter Schiff, some notes from what he had to say. It's been about 10 years since gold seen these numbers that it's showing today. A lot of money printing has gone on. People thought the Fed's actions were temporary when we look back at 2007, 2008, 2009. It's not temporary. And people are getting rid of dollars and buying gold. We even saw that in that story from Turkey. There's no way out for the Fed. No way out for the Fed. So what are your thoughts on some of those things that Peter Schiff had to say? So while you go ahead and put your thoughts in the comment section, which we'll take a look at, let's go ahead and take a look at something Jim Rickards went and said.
I had a very interesting conversation with Jim Rogers. Jim is one of the great commodity traders, money managers of all times. And we were down in Dominican Republic at Casa de Campo. This is around 2014, but the bear market started in 2011, but it really fell off a cliff in 2013. So I said, Jim, what do you think of gold? What are you doing? He goes, well, I own it, of course. And he said, I'm not selling, but I'm not buying right here. And he says something that just hit me right between the eyes and it stayed with me. And of course, he's right. He said, gold's going to the moon, but nothing goes to the moon without a 50% correction along the way. And if you look at the high in 2011, $1,900, approximately, and where was the bottom of the bear market? It was $1,050 on December 16, 2015. Nobody knew it was the bottom at the time. But if you look at that drop down and you use $250 as your base, because you need a base. So you had basically the run from 250 to 1900 was $1,750. Go down 50% from there, it's $825. 1900 minus 825 is 1075, and the bottom was 1050. So Jim totally stuck the landing. Like at 1050, okay, there's your 50% retracement. Now that's the bottom. Now it's going up, and the sky's the limit.
Okay, so gold is going to the moon. There will be there are going to be corrections along the way. It could be 50%. So you got to kind of wonder, that $2,000 gold price, is that the 50% retracement that they're talking about for perhaps $4,000 gold or even higher? As they say, sky's the limit. So let's see what your comments are out there. A lot of you guys seem to be more agreeable with what Peter Schiff has to say than Rickards. I tell you, both guys, they got good points. I'm kind of leaning a little bit more towards what Schiff has been saying as well, but we'll go ahead and take a look at another clip from this interview.
I don't think there's going to be any significant pullbacks from here. I mean, there'll be pullbacks, but I don't think they're going to be very significant. I think if you're waiting for a big drop to buy gold, you're going to wait a long time. And when you finally get it, I think it's going to drop from a much higher price than it is if you just bought it right now.
Yeah, I agree with that. When I was talking about retracement, we had it. The retracement's over. I'm not forecasting a retracement. Quite the opposite. I think it goes a lot higher from here. My point was that we had the retracement between 2011 and 2015. That's done. Now it's just onward and upward.
Yeah, the thing about Jimmy Rogers, though, I ran into him at many conferences, and he was waiting for a retest. I mean, Jim was waiting for gold to go to 1,000, and then he was going to buy more. I kept saying, Jim, it doesn't make sense. It's too risky to wait for 1,000 because it may never come. And of course, it never came. And then there were a lot of people who were waiting, for 1,200 when it was at 1,500. I mean, the world is going to be full of people who are waiting to buy gold and who are broke because they didn't just bite the bullet and buy it.
Okay, so should we be waiting for pullbacks? I mean, some people say yes, some people say just get it now. Gold and silver, they're in two different places right now. And from where I sit, gold is still relatively easy to obtain supply. However, silver Silver's a different story, especially when it comes to coins. Bigger bars, LBMA bars, they're okay. But when it comes to coin, it's a little bit different story. The silver supply looks to be tightening up much more than gold. And I want to submit something to you so that we kind of all get on the same page with what's going on. This is also from Peter Schiff, his page. U.S. Mint struggling with gold and silver coin production slowdown. Okay, so U.S. Mint is limiting the distribution of gold and silver coins to authorized third-party distributors due to production slowdowns. According to a Bloomberg report, the U.S. Mint complex in West Point, New York, is taking measures to reduce the spread of the bug among its employees and expects production slowdowns for the next 12 to 18 months. Okay, so are we getting this? Production slowdowns for the next 12 to 18 months. According to a U.S. Mint document, the facility can no longer simultaneously produce both gold and silver coins, forcing it to choose one metal over the other. Okay, so hang on there. So that's it's pretty severe. So according to that document, they can no longer simultaneously produce gold and silver coins and forcing it to choose one metal over the other. So this is coming from the U.S. Mint. So curious to see what your comments here are. I mean, we already have a coin shortage going on, right? That's my understanding with the U.S. And now U.S. Mint is talking about they're going to have to, basically look at gold and silver coins, and they're going to have to make choices one over the other. And they're saying that they can't keep up. Expect slowdowns for the next 12 to 18 months. Mike Saraceno, yes, U.S. Mint stopping fractionals. Okay, so there you go. Kind of makes you wonder. I mean, you would think that at this time in history, this is when you're going to need these types of coins the most, and you see them slowing down with it. Kind of makes you wonder. Magic Man, 200 silver is very reasonable target. Imagine if just 1 in 100 people start stacking. And that's exactly it. I mean, even though we're seeing the spot price saying one thing, if you go and try and buy the physical, you're going to see something else for sure. So that's a good point with what you're saying there. So from an inside position, meaning where I do work for a company that deals with silver, gold, systemic wealth protection, things like that, all of the important things right now, I'll tell you, I'm going to say this straight up, no sugarcoating, straight up. This is the reality as it pertains to silver. North American coins from the U.S. Mint, Royal Canadian Mint, they are going to be harder to obtain outside of North America. If you're in Europe, Asia, Africa, supply on those coins from those mints are going to tighten. They're going to tighten up perhaps like something maybe we've never seen before. So again, coins from North American mints, Royal Canadian Mint, U.S. Mint, they do look like they're going to tighten up quite a bit. Across the ocean, European minted silver coins such as Britannia's, Austrian Philharmonics, which are taxable. And this is the interesting part. They're taxable in many places throughout Europe. And it creates a position where Asia, Africa, and U.S., they're going to import Philharmonics, Britannia's, because possibly it's going to be harder to get North American coins from Canadian Mint, U.S. Mint. They're going to look more towards European mints, things like Britannia's, Philharmonics. And with Europe has a pretty high tax on silver from what I understand. So the demand for silver because of that tax simply may not be there compared to the demand that's going to be coming from U.S., from Asia. So you got to kind of, think to yourself, again, is buying the dip something you really want to do, or is understanding what's even going on with the supply now? I mean, if you even take price out of the equation, factor in supply, it does add a different component to probably the rightful thinking process of trying to buy on the dip. We all want to buy low. That's correct. So I'll bring this question: should we be waiting for pullbacks? if you're in a place such as Singapore, uh, no taxes. You can buy gold and silver, no taxes. So pretty much you're ahead of a lot of other countries at this point. And if there is a pullback, would we even recognize it? I mean, what if the pullback was just 20 cents? You know, do we know that's the pullback before it goes up? We don't know. So would we even know what the pullback is, or what point, or what price that it's looking for? So additionally, will you even be able to get the silver, which is what I'm talking about here, especially when it comes to coin? Bigger bars seems to be okay. Gold seems to be okay, but silver coinage seems to be tightening up. So you factor in these concerns, and you can see why people are seeing a silver slingshot that's in the works. So something to think about. So let's get back to Schiff and Rickards, what other things that they had to say.
So I've spoken to an economist recently who told me that if you look at the last time that the Fed expanded its balance sheet on a significant level during the last recession, what we saw was gold rising in tandem along with the expansion of the Fed balance sheet. In fact, during the years 2009 to 2011, that 3-year period, gold rose 200%. And so if we apply the same growth metric to today's situation, where we also have the Fed expanding its balance sheet, what we're going to see is a $4,000 gold price target. Could this happen? Peter, let's start with you.
Well, remember, too, the only reason that gold stopped rising at 1900 was because the world was convinced that the Fed could unwind the policy, that it could normalize rates, that it could shrink its balance sheet. Had the market not believed that, then gold would have kept rising. You know, the way they were able to stop the price of gold from going up in 1980, that prior bull market, was because Paul Volcker did the right thing and let the market set interest rates, and rates went up to 20%. And that broke the back of that gold bull market. Well, what's going to stop gold this time? They can't let rates go up because we're too broke to afford it. They're not going to be able to bluff that they're going to raise rates in the future, because no one's going to believe that. They're not going to be able to pretend they can shrink the balance sheet, because if they couldn't shrink it when it was $4.5 trillion, how are they going to shrink it when it's 10 trillion or 20 trillion? Who knows where it's going? So I don't really see how there's any way that they can stop the dollar from collapsing. In fact, in 1971, that's when we went off the gold standard, and the dollar got marked down sharply. In the decade ahead, it lost about 2/3 of its value against the euro. I mean, not the euro, the Deutschmark, the Swiss franc, the Japanese yen, and it did even worse against gold. But I think now it's not just the dollar severing its ties to gold. It's going to be the world severing its ties to the dollar. The world is going to go off the dollar standard and back on the gold standard. And I think that this is going to be a more precipitous drop in the dollar's value than it was in the 70s. And so we can see something equally as impressive in the price of gold.
Okay, so some notes. Gold over 3,000 cannot stop the dollar from collapsing. The world will sever ties to the dollar. World to go back on the gold standard. So curious to see what are your thoughts on that. For me, can't stop the dollar from collapsing. You know, I think that is true. I think the question with that more is will that actually happen, or will they transition us over to that central bank digital currency before that collapse? I mean, are they going to let it happen, or will they try and smooth things over and move us into that new currency before these things happen? So it's going to be something out of our control. That's the question I would have from here. The world will sever ties to the dollar. It's already happening. If you folks been following things like Instex, which is the European rival to the U.S. SWIFT system, these things are operational already. So they are looking to get away from the dollar. Russia, China, even Europe, traditional allies, they're all looking to get away from the dollar. So it's pretty interesting what he had to say. Let's see. George Kaiser, gold standard will never happen. Digital money will be the new standard to tax that. Well, I wouldn't say never happen. You just don't know. There could be a type of a gold backing to, let's say, these new central bank digital currencies. And the reason I say that is for two reasons. One, when new monetary systems start, or currencies start, they do have a tie-in to gold. And the other thing, you got to imagine, do you really think people are going to move from an unbacked fiat currency into an unbacked digital currency by the same banks. I mean, I don't think people are going to be accepting of that. I mean, people who understood what happened and why things are happening now, I don't think they're going to accept that. So I think, even the banks they're going to be smart enough to understand that, hey, if we do this, uh, guys are going to revolt against it. And they're going to need you to go into their money freely and willingly, not go into it questioning it, because as you guys know, money, it's just confidence. Whatever you have confidence in, that can end up being money. And without that confidence, it's not going to fly. So I do think the Fed, all these central banks are going to have to come up with something for people to believe in at this point. So take a look at another topic that they talked about.
Where do you think gold is headed from here? Are we overheated? Do you see more room to climb?
Well, we're not overheated at all. I've got gold at I would put it at $15,000 an ounce before 2025. But as I point out, if you're going to $15,000 an ounce, you got to get to 3,000, 5,000, and 7,000 first. So there's plenty of room to run, plenty of room for profits. But when I say things like that, David, I want to be clear. There's a lot of analysis behind it. I don't just pull a big number out of the air and for publicity, because I could care less. But if you just took the average, there are a couple ways to think about it. Just take the average of the two prior bull markets I mentioned. So 71 to 80, 9 years, 2,200%. 99 to 2011, a 12-year bull market, about 700%. Just take the average. You don't have to go to the higher of the two or extrapolate. Just take the average of those two bull markets. You would say, okay, well, the next bull market is going to be a little over 10 years, and it's going to go up. It's going to go up 1,500%. So using that as your base, just take the average of the two. You say, all right, 10 years from 2015, that puts you out to 2025, and at 1,400%, it puts you at $15,000 an ounce off a 1050 base. So that's just history. But there are other ways to think about it. Now, going to Peter's point, I don't know if there'll be a gold standard or not, but I do know that gold will move. The price of gold will move in the direction of where it would need to be if you're going to have a gold standard. And I talked to Paul Volcker about this, and he agreed. If you just took the money supply, so just take M1, which is pretty widely accepted definition of money supply. Take it for the U.S., the ECB, UK, Bank of Japan, and People's Bank of China. There are other entities you could include, but that's over 75% of global GDP right there. Divide that number by the official gold, which is about 34,000 metric tons, a little bit less, you come to $15,000 an ounce. So if you're going to either have a gold standard or even use gold as a reference point for money, if you need to restore confidence in the dollar, the implied non-deflationary price is $15,000 an ounce. So what I find interesting is that if you use just the history of the last two bull markets and average them, or if you use a rigorous calculation, what's the implied non-deflationary price? Interestingly, they come out in the same place. I don't think they have to. They're two different methods, but they both point to $15,000 an ounce sometime over the next 3 or 4 years.
Okay, $15,000 per ounce around 2025. What do you folks think? Are we looking at $15,000 per ounce gold by 2025 relative to if you put it up against the monetary supply? I mean, this is where he's more or less getting his numbers from. It's a simple mathematical formula, as he says, and it comes out to roughly about $15,000 per ounce. So what do y'all think about that? Truth or nothing? 15,000 an ounce means bread is going to be like $2.50 a loaf. That's a good point, because let's say if you're going to measure gold in U.S. dollars, what about other real things such as commodities and whatnot? I mean, are these going to also go up? Are we going to be looking at that type of inflation across the board? Or do we realize that gold has a certain price relative to other things, which may not be able to be associated in dollar-denominated terms, simply because how do you gauge what a dollar is worth anymore at that point once you have hyperinflation? So, I'm not even though they give a number, I tend to look at things more like, what is gold going to be relative to another commodity? Because commodities are things that are real. So personally, I like to think of it as what is it going to be comparative to something else that's real, not necessarily in dollar terms. So it's a good point you brought up there. Um, let's see, Brian Taylor, what is? Hang on, let me get this out. Oops, hang on. Okay, what is considered money is that which is quantity can be established upon which. Hang on, whose quantity can be established upon which consensus can be reached. Yeah, sorry about that, Brian. It's a good point as well. What are we going to consider money? You know, so again, something else that we have to consider. I mean, even though it's in dollar terms, we may not even recognize what a dollar is anymore at this point. So let's move on to another clip between the two gentlemen.
Well, you know, another way to look at it, Jim, is just look at the price of gold in relation to the Dow Jones, because you have historical reference points where twice in the prior century at significant bear market lows, the Dow traded down to a single ounce of gold. In 1932, the Dow Jones was roughly equal to an ounce of gold. And in 1980, the Dow was roughly equal to an ounce of gold. So if you look at where the Dow is now, around 26,000, and figure, well, where would the price of gold have to be equal to the Dow? Well, at the current price, 26,000. But maybe if we get a big bear market, those two could meet around 15,000. And so you'd have the Dow Jones at 15,000, which is significantly below the current level. And you'd have gold much higher. But of course, if they create massive inflation to prevent that stock market bubble from deflating, it's possible that an ounce of gold and the Dow could meet at 50,000. I mean, it does, you know, the key is that they're the same price at some point, not necessarily what that price is, but that they're the same.
That's right. And you know, David, when I say $15,000 an ounce, I don't think I'm stretching. I mean, Peter's right. Could it be 25,000, 40,000? I mean, just take my monetary equivalent. If you use M2, and by the way, when I used M1 and did that math, that's with 40% backing, because historically 40% has been a high level of backing. If you take M2 at 100% backing, you get to 50,000 an ounce in a heartbeat.
50,000 an ounce. So 15,000 is on the conservative side. 50,000 is another number being thrown out there. 50,000 gold. That's a huge number, and you'd have to think, you know, really the whole monetary system is in ruins at that point if it ever got to $50,000. And some guys have made the point that, you know, the world isn't going to end. It's nothing like that. It's just that they're going to evolve into a new monetary system. And again, this is something that, you know, do we evolve into it, where usually evolving is something peaceful, or you know, I mean, an evolution into a monetary system, or is there going to be a revolution that's going to force us into a new monetary system? And this is it is concerning, because when you look at it from that point of view, the Federal Reserve, the governments, they hold all the cards, you know, whether they're going to make this peaceful or whether they're not going to make it peaceful. And you know, it's something I think none of us can take lightly, and this goes for probably every government in the world right now. So I'm looking at some comments, great comments going on. Let me see if I can pull any out there. Let me see. Ralph Steiner, no one wants USA as reserve currency anymore. It's a lizard currency. Well, scratch the second part of that. The first part, no one wants USA as a reserve currency anymore. You know, I'd have to you got to be real. You know, you have to be real, and countries do want to move away from the US as a reserve currency, and a lot of it has to do with, over the years, how the U.S. has chosen to weaponize that dollar, and it puts a lot of countries in a bit of a bind. So this is one reason, again, why countries are looking to get off the U.S. dollar, and it's not just the weaponizing; it's also what's going on with the central banks. I mean, when you see all this money printing going on, and you know, you really got to wonder, well, what is the value or the worth of a dollar at this point? If they're just printing it, giving it to people for free. it kind of makes you wonder, bailing out businesses, zombie companies, things like that. I mean, the money's just being thrown around all over the place, and here you are having to work for it, or even especially in a foreign country, you're having to work producing real things, and you're getting this paper, and then you're seeing this paper just being conjured up at will and just being thrown all over the place. Outside the U.S., it really makes you wonder. And I can tell you, because even though I am from the U.S., I'm outside the U.S., and makes you wonder. Real products are being produced, real time, real labor. Uh, they're being shipped over, and then you're given this paper, which is just being printed at will. So it's something that central banks and governments are doing that is starting to cause less confidence of owning or wanting U.S. dollars, and more of a feeling to move away from the U.S. dollar. So we'll go ahead and take a look at another question or a comment these two gentlemen had to say.
I mean, look at what we're doing now. All the bailouts, all the enhanced unemployment benefits, the PPP, right? Everybody is getting bailed out, and nobody is getting a bill. Nobody's taxes are being raised. Everything is being paid for by the Fed, because we think it's all free, because everybody believes in MMT, whether they want to acknowledge it or not. But we're about to see that it's going to be a complete disaster, because the dollar is going to collapse. And then, of course, what the MMTers don't get is, well, what do you do? What happens when inflation goes out of control? What happens when prices really start to go up? How do you stop it? Once you've let that genie out of the bottle, how do you put it back in? It's impossible.
Okay, so modern monetary theory, everybody gets free stuff. Inflation will set in. How will we control inflation? I mean, if we go back to the Volcker years, he did it by raising interest rates. Something we can't do right now. If we were to raise interest rates, I mean, it's everything that removes every plug that is trying to hold back the dam right now. Everything's going to just break loose if ever you try to raise inflation rates right now. So that's just not going to happen. And it's always been a question where, the Fed has been wanting inflation for so long, they could never get it. And the thing now is, okay, if they do get it, what are they going to do? What are they going to do? And I think, it's the Fed probably will not be able to control that inflation, which is something that Schiff is kind of alluding to. So let's take a look at something else that these two gentlemen had to say.
Quantitative easing has been one of the driving factors behind the equities bull rally. Can you see this stopping anytime soon?
No, I mean, Peter's right. The Fed dug a hole and they can't get out of it. And I said all along, but certainly, 2014, 2015, et cetera, as they did the taper, and then they did the liftoff, and then they raised rates and all that. I said the Fed is trying to get out of this. They're trying to normalize the balance sheet, trying to normalize interest rates. Normalization meaning they'd love to get rates to around 3.5%, 4%, and they'd love to get the balance sheet down to maybe $2 trillion from a level of $4.5 trillion where it was in 2014, and a level of interest rates of 0. So they had to get rates up, balance sheet down. Why? So they could prepare for the next recession. They weren't forecasting a recession, but they knew one would come eventually. And it takes about 4 to 5 percentage points, 400, let's say, basis points of rate cuts to get the U.S. out of a recession. How do you cut interest rates 4% if you're at 1? Well, the answer is you can't. And that's why they came up with quantitative easing. So the effort was get to 4% rates, $2 trillion balance sheet, and you're ready for the next recession. That's what they were doing. That's what made Fed forecasting the Fed child's play. It was very easy. But I also said they won't be able to do it. They will not be able to prepare for the next recession without causing the recession that they're trying to prepare for. And that's exactly what happened in the fourth quarter of 2018. Between October 1st and December 24th, 2018, the stock market dropped 19%. It was 1 point away from a bear market at that stage. And then you had the Christmas Eve massacre. And that's when Jay Powell threw in the towel. He got religion. He said, okay, first he said, we're not going to raise rates anymore. Then he said, we're on pause. Then he said, we're actually going to cut rates. And then 9 months later, he said, we're going to end quantitative tightening, which was reducing the balance, the money supply. And then in September 2019, they started QE4, which is that was before before the recession, before the depression, before the pandemic. They were already in QE4 and cutting rates again. So they can't get out of it. Now it's worse because they're back to zero and the balance sheet's up to $7 trillion at this point. So they prove that the failure is manifest. They prove that they can't get out of it. And what can they do? But
Yeah. Okay. So some notes on what Jim Rickards had to say. QE may not be stopping anytime soon. I think we know that the Fed has already hinted that they're not going to be raising rates all the way into 2022 or possibly even beyond. Fed has been all over the map. We've seen that raising rates, trying to cut back, taper off, can't do this, can't do that. And we've even seen explosions going on in the repo market. Fed has truly been all over the map, and even literally where they have created programs all over the world to try and get liquidity into different countries all over the world. Fed could not get their 4 to 5% interest rate runway, which they needed. Typically, whenever you go into a recession, you're going to need to cut rates by about 4, sometimes 5%. They didn't even have that. I think they were at about 2.75% before all of this even started, which is why the Fed is trying to hang on as desperately as they can not to go into negative rates. I don't know if they're going to be able to do that. But in trying to prepare for the next recession, the Fed actually caused the next recession. So what can the Fed do? Probably more importantly, what can you do at this point? There are things, as we say, you have to start creating a hedge against the Fed. There's no other way to put it. You have to hedge yourself against the Fed. And what is the Fed? The Fed is currency, money, which means your hedge has to be money. You have to hedge things where it's money to money at this point, or currency to money. And this is the way a lot of guys are looking at things right now. Let's see. It's a good point. All world wars happened after the Federal Reserve started in 1913. I'm not sure if I go so far as to say that, but it is true that banks often do fund both sides of wars, or central banks do. So I completely get that part of your statement, the intent of it. I absolutely get that part of it. Let's see. Elbow Sanchez, dollar is worthless. Well, that day might come. I mean, we've said this before, have some cash, but cash does have an expiration date on it. I think everybody knows that. All fiat goes to zero. So cash definitely does have an expiration date. And again, that's why you want to make sure you have things like junk silver, gold, even things like Bitcoin. And then for me personally, I've always looked at the gold-backed token, which for me is cash gold token. That, and a little bit of a disclaimer, I do have a micro share in it, but it is the gold-backed token that I've been looking for. It does, in my opinion, it does things that other gold tokens simply don't do. And again, those things are important. Have some physical cash, but it does have an expiration date. Junk silver, gold. You want to have some Bitcoin, and then you want to have CACHE, cash token, for me anyway, as a gold-backed token. And so those are very important as we see. We're going to see in time that, as I mentioned, countries are going to want to start moving away from the dollar, and it's going to be more prominent. I think we're going to start to notice this more and more and more. So let's see. What else is out there as far as comments? RR, price controls are coming. Could be, my friend. I mean, when we talk about currencies getting into trouble, usually price controls are something that does come into play. It could very well happen. We've seen that before in the 70s, when I think it was Nixon who imposed some price controls on things. So it is a reality. These things do happen. Okay, so let's move on to something else that these gentlemen talked about.
I mean, look at what we're doing now. All the bailouts, all the enhanced unemployment benefits.
Oops, sorry. I think we already saw that. So let me move forward. Let me find where I was. Okay, so we were here last. Okay, so let's move to the next clip.
All right, we have a few minutes left, so I have one last question for the both of you. What are the major risks that you're looking out for today? We're already living through the worst pandemic in recent history. We're seeing a recession that some analysts would say is even worse than the Great Depression of the 1930s. And in response, we're seeing monetary stimulus on a historic level. Jim, let's start with you. How could things possibly get worse from here?
Yeah, well, first of all, I encourage everyone to stop using the word monetary stimulus. There is no monetary stimulus. There is money printing. Yes, there is money printing and debt monetization, but it has no stimulative effect. You don't get inflation from printing money. You get it from velocity, which is psychological, which the Fed doesn't understand. But the biggest threat is deflation.
First of all, the only thing you're going to see deflation measured in is gold. But in terms of fiat currency, prices are going to go up dramatically because they will continue to print the dollar until it no longer has value. That's the only thing that's going to stop it. But look, what we've seen so far, even with the civil unrest and the riots and the looting, this is just a small dress rehearsal for what's coming. Because when the dollar crashes, and prices skyrocket, right? These stimulus checks, or whatever welfare benefits the government wants to dispense, they're not going to be worth very much. I mean, because you're not going to be able to buy anything. And I think the government is going to respond to the surge in consumer prices with price controls, kind of the way we did in the 1970s. But prices are going to be rising much faster now than they did back then. But I think there's going to be controls on all sorts of consumer goods. And that means shortages. That means long lines. And I think there's going to be power rationing. And so I think you're going to see a real blow up, particularly in the cities. There's going to be a lot of crime, a lot of violence associated with widespread shortages and a lack of food and power outages. So things are going to get pretty bad as we go through a monetary crisis. It's not, this is not just a financial crisis. This is a U.S. dollar crisis and a sovereign debt crisis. That's a whole nother ballgame.
Okay, it's a whole nother ball game. Do you think deflation is the biggest risk ahead? And I think the Fed has already made it known that deflation is their biggest risk, and which is why they're leaning toward inflation. They want that inflation. And as one of you guys already pointed out, you're seeing a big spike in lumber costs. And I briefly read through some articles with lumber, and it seems like lumber is getting to be sort of like silver and gold, where they're having supply issues on lumber. And we've seen the prices of lumber go up. And again, can easily relate that with silver and gold, where we did see supply issues and the price went up. Even though spot price said one thing, if you tried to buy it, you were seeing something else. And this is kind of what I'm seeing with some home improvement outlets, where the price of lumber has gone up significantly. Things as simple as 2x4x12s tripled in price, and stock is just not readily available. So I'm curious, is that what you're seeing in your neck of the woods as well? So looking at some of these comments here, let's see, Nick. Okay, it's not only inflation on the lumber, it's backup order, factory and production stop. That's why supply and demand as easy as that. And that's what I've been hearing as well, where it's somehow the supply of lumber is starting to, I don't want to say break down, but it's not as moving as easily as it once did. That's for sure. We're seeing it. Martin Lee, global banking crisis now looming. Yeah, the Fed has been covering up this, covering up that, and you kind of sort of didn't hear too much news about banks. Just a little bit, not the way we've heard it back in 2008. And, because they're saying this is more or less because of the pandemic and things like that. But I agree with you, Martin, and especially when we see things like Warren Buffett and how he basically dumped J.P. Morgan, kind of tells you that maybe something with the banks is on the way, where it's going to start to crack a bit more and more, where we can finally kind of peek into that crack and see what exactly is going on with the banks and how sound they are. So that was another point that Schiff had to make, both Schiff and Rickards, about deflation. So let me move over into another clip that the two gentlemen had to talk about.
Yeah, well, I agree with Peter that the Fed wants inflation, but they don't know how to get it, and they haven't for the last 12 years.
Well, that's the one thing they do know how to do. They can cause inflation. That's all they can do. They can print money.
No, they can't. They can't, Peter. They printed $7 trillion in 12 years, and we got no inflation. Assets, yes, but I'm talking about.
I mean, prices
I'm
are
talking.
higher than they were 7 years ago, consumer prices, but we inflated a stock market bubble. We inflated a real estate bubble. We inflated a
If you,
bond
if
market
you,
bubble. I mean, asset
okay,
prices went way up. We
okay,
distorted the economy based on all that inflation. And look, consumer prices have risen, right? I mean, I don't care the way the
not
government
much.
wants to keep track of them with their, with the CPI. The CPI is not an accurate reflection of what's actually happening with consumer prices.
It's pretty good. Look, if you want to count assets, you're right, but you're changing it's moving the goalpost. You're changing the definition.
No.
If you count assets, yeah. If you count assets, yes, but I count consumer prices or PCE core deflator because that's how. If you want to predict Fed policy, that's what they look at. So you need to
I don't
consider
care what
it.
the Fed looks at. I care about reality. And prices are going up, but that's not inflation. Because if the Fed didn't create all this inflation, maybe those prices would have really come down. Maybe consumers would have gotten the benefit of a lower cost of living. But the Fed stole that benefit away from them by creating inflation. But look, all of this inflation is going to come home to roost. All of a sudden, we're going to catch up and we're going to see dramatic increases in consumer prices. And then when you go back over the entire period, you can say, oh, look, prices are up 10% a year or whatever they're going to be, because all of a sudden they're going to shoot way up. And it's not going to matter that they were benign for a while when all of a sudden they skyrocket and catch up to where they should have been. But the cause was all the inflation the Federal Reserve has been creating the entire time.
Well, I agree that if the Fed didn't do what they did, we would have had more deflation. And in a way, they were just fighting it to a standstill. But we haven't had inflation for 12 years. Asset prices, yes, but that's not the definition of inflation.
The definition of inflation is an expansion of the supply of money. And that's what we've had in spades. This is the greatest inflation that the world has ever experienced.
You can make up your own definitions, Peter. The definition of inflation is higher prices.
Jim, I'm not making up the definition. It's people today. You go back and get a Webster dictionary from 100 years ago, and you read what inflation is, and it'll say inflation is an expansion of the money supply of money and credit. Rising prices are an effect of inflation, right? Prices don't inflate. Prices go up and they go down. Money supply inflates. Inflate is to expand, right? You don't expand prices. What is being expanded is the supply of money. That's inflation. Inflation is an expansion of the money supply. Deflation is a contraction of the money supply. The effects of inflation and deflation are on prices. When you have inflation and you're inflating the money supply, prices will go up. And when you're deflating it, prices will go down. But sometimes you can inflate the money supply and prices don't go up because the inflation is preventing prices from going down. But don't confuse changes in prices with changes in money supply. Money supply is inflation. Prices are just prices.
The problem, Peter, look, we're talking past each other because we have two different definitions. If you say that prices are flat, but that's inflation, fine. That's not how any central bank in the world or any economist thinks about it.
The central bankers want to pretend that inflation has to do with prices because they don't want to be blamed for it. When you accept the real definition of inflation, which is an expansion of the money supply, then you know who causes it. It's government. It's central banks that cause inflation. But governments want to blame inflation on the private sector. That's why they want to redefine it as prices. And you're playing into their propaganda by trying to perpetuate the idea that inflation is caused by greedy businessmen raising their prices or labor unions or speculators.
Now you're way over the line because
you're saying inflation is prices going up.
You're putting words in my mouth that I never said. I said that inflation is measured by prices. That's just how you do it. If you have a different definition, that's fine.
Now, inflation is measured by the money supply.
Well, you knew that there wasn't going to be a little bit of fire between those two guys that were. You knew there was going to be something that came up. There's disagreement on inflation. So who's right? Is inflation printing money or is it prices? And, I think, I've shown this before, where if you go back to 71 when Nixon closed the gold window and you just look at home prices, we looked at the U.S., we looked at the U.K., we looked at Australia. And when you seen the charts on home prices and how they just went through the roof since Nixon closed that gold window, that's inflation. I mean, the yard didn't get any bigger. The home got older, and yet the home is going to cost more to get. How do we it's not a collectible, is it? I mean, it's things that are older that get more expensive. Usually they're collectibles and things like that. But, the yard didn't get any bigger. The home got more aged. Plumbing started getting rust. The paint started chipping, cracking. Maybe the home was never even expanded. It's just the same way it was back in the 70s. And yet it's double, triple, quadrupled the price. And that is inflation. Well, without a doubt, that is inflation. So let's take a look at one more thing that Peter Schiff had to say.
Only source of the money is the Fed. So obviously they're going to embrace this theory because it's so self-serving. And, they've been lulled into a false sense of complacency because it seemed that we've been able to get away with it. We have printed all of this money since the '08 financial crisis, and everybody thinks it hasn't caused a problem. Everybody says, look, see, there's no inflation. We printed all this money. We had the balance sheet has exploded. And look, prices haven't gone up. So they now have this false sense of security that there's no limit to how much they can print. Well, what's basically been keeping us from having to deal with those consequences has been that reserve currency status, has been the willingness of the rest of the world to hold on to that paper in the form of treasury bonds or corporate bonds or mortgage-backed securities or even U.S. stocks, right? So as long as they're willing to park the money in financial assets, then it doesn't bid up consumer prices. But once they lose confidence in the dollar, then they lose confidence in all dollar-denominated assets, and now they want out. And now all that money is going to come rushing back to the U.S., bidding up the price of whatever's not nailed down.
Okay, so we are seeing today things that we have been told about years ago. Fundamentally, the Malloneys, the Schiffs, the Rickards, the David Morgans of the world, they're right. It was just timing that was a bit off, but who really ever gets timing correct anyway? But fundamentally, these guys were all correct. These are same people also talked about deflation and inflation. A phrase I often hear is never bet against the Fed. Interpretation, the Fed cannot let deflation happen. They've already calibrated their compass in the direction of inflation. And since that compass is pointed to inflation, this again is why you want to have things like gold and silver, wealth preservation, wealth protection, things like that. It's a hedge against inflation. So we are going to have pullbacks, of course. Nothing ever naturally goes straight up. Therefore, should you buy a pullback? Should you buy a dip? Well, if it were generally an infinite supply like paper bills, even stocks, bonds, why not? Go ahead and wait to buy that dip. If it's a finite item like silver, like gold, keep in mind, big money is out there and will buy precious metals like silver without waiting for a $2 dip to go down from 27 to say 25 when they realize gold is going to be worth more than $50 and over. So they don't necessarily need to wait for that $2 dip. They're just going to buy it. And I've made it known to all of you that from an insider perspective, silver is tightening up more than gold. So even though I have access to gold and silver, perhaps more than all of you out there, there are countless times that even myself, I've planned to put in an order to buy gold and silver if the price went down just a bit. And probably 90% of the time as I waited, money moved in and bought up supply or bought the things that I wanted to buy, and I had to go ahead and wait weeks for that order to come in sometimes. So you got to understand it's not just you that wants to buy. You're going against millions of people as well who do want to buy, and they may not necessarily be waiting for that dip like how even I sometimes do, how sometimes you do as well. My fear is one day reorders, they're going to be bought up way into the future already, and I'm not ready for that. I still need to get some silver, get some gold as well. Are you ready for that? Okay, if supply starts to dry up, are you ready? Do you feel you comfortably, confidently have enough? I mean, if you want gold and silver, as I said, so do an increasing amount of people. And what happens when many people are going after the same item? What happens is price goes up. That's where inflation, a form of inflation, starts to set in, where prices start to get bid up. So as we wait for spot price to come down to buy the dip, with supply issues, you see premiums actually go up. So in the end, do we really save when we're waiting for the dip if premiums on the other end go up because of supply issues? So you got to keep in mind Jim Rogers, who was waiting for a dip, $1,000 gold. Jim, if you're watching, sorry about that. But he was waiting for $1,000 gold. He's a savvy investor. He knows the markets. Never came. And now that $1,000 gold is fiddling around 1950, 2000, almost double from what he was waiting at. For a guy like Jim Rogers, it's okay, but for you and me, average Joe, even some pretty wealthy people, it's a big change, and it can sting. Overall, it's a personal choice that we all need to make. Do we buy the dip? It may be popular with paper assets. However, with the finite supply, as we mentioned, of physical assets and bifurcation, where spot price and true physical price starting to separate a bit, is it really worth trying to buy the dip? I'm not trying to rush anyone into buying or anything like that. I'm just saying, we need to look at all different points of view from this. So, the true physical price premiums on the rise, combined with the Fed wanting inflation and setting their compass pointed in the direction of inflation, and prospect of things like a second wave where mines may shut down again or whatever it is. I need your advice this time. You tell me. Give me your best advice. Should I wait? Should I wait for a dip? And a lot of people also want to know the same thing. Should we be waiting for a dip, or do we realize that supply is tightening up a bit? And do we realize that, even though, let's say, spot price goes down because of the supply issues, premiums go up. So do we really save? Is there a true risk reward in that? I mean, take a look at lumber. We're seeing lumber 2, 3, 4 times the price already at this point. So let's see. I saw some of you guys say that Schiff won the debate, or I'd have to agree. I don't think it started out as a debate, but sure ended up into a debate. Got pretty heated in the end. Schiff, he seems subdued. It seemed like he was just picking the point where he would move into battle mode and really lay down the lumber, which is hard to find nowadays. But he made a lot of great points. Rickards made a lot of good points. So did Schiff. So it's a pretty interesting interview from Kitco. I'm glad Kitco put that out for all of us to see, and I'm glad we had time to share it and take a look at it. So let's see if there's any other comments out there, and then we'll be heading out. Just getting a bit going into overtime. Truth or nothing, and the Fed. That is true. I think that's going to be the sentiment more and more as time goes on. We're going to see more people looking at that phrase and acting on it more and more. Let's see. Magic Man, you can't argue with Schiff. Yeah, ever. He's like a pit bull, man. He's just gonna bite you, and he's not gonna let go. You really better know what you are getting into with Peter. But interesting guy nonetheless. Interesting guy. Joe SMO, Ron Paul. We had our chance 2 times to end this madness. That is true. We've had multiple chances. I think it was under 2013. I believe 2013. The Fed was their charter, I guess, was renewed or sorts. I don't know if that's the right terminology, but we let them continue. And if we let them continue, we can also be the ones to more or less push them out. And it's something. Again, we're going to have to wait and see what happens, because it does look like our currency system is going to either evolve through evolution or revolution. And it's something. Again, I hope it's evolution. It can't stay the same. Seymour Rivers, our winner, David Morgan, Silver Manifesto ebook. I think you're gonna like it. I agree with Peter. Yeah, Peter made a lot of great points out there. So let me just look through a few more comments before we wrap up. Let me see here. Hang on. Sorry about that, guys. I just saw something that I need to pull up. Okay. Let's see where to go. Hang on. Sorry about this, guys. I just need to find it. Um, okay. Bill P. Thank you. Thank you again. Just think about it. An expert was wrong, referring to Jim Rogers, I suppose. Just buy and average it out. And that's true. That's a great point, Bill. Even the experts get it wrong. And, like I say, do we wait for the dip? Do we buy on that dip, or do we just understand what's going on right now and just go ahead and get it? If you were to buy it today at today's price, within a month, it's probably won't matter that you bought it at today's price, because that price always moves, and the situation with the Fed, the printing, everything going on, it's not going to change. It's not going to change for a long, long time. So, it's something. Getting gold and silver, it's something that should be on everybody's radar right now. And I'm not passing on any type of financial advice, professional or otherwise, disclaimer. It's just something that I personally do to offset what's going on. So again, I do hope you guys really take a look at what's going on as well. And so Cody R. Let me get this up there. Silver Eagle on me. Cody, appreciate that, my man. That is that's pretty cool. I really do appreciate that. That is my favorite coin. So appreciate it doubly as much. Thank you very much, Cody. So with that, Cody, my man, we'll be wrapping up this segment of or this episode of our live stream. Sorry, Cody caught me off guard, man. Anyway, thank you guys for being here. Cody, Bill P, all of you guys, take care of yourself out there. Appreciate the time that you've spent with us. Look forward to seeing you next week. Just keep an eye on things. Watch that lumber. Pay attention to what's going on in the financial situation. And, one day we're going to have good news to report, other than buy more silver, buy more gold. But it does seem to be the thing to do right now, and something that's going to be useful and helpful in the years ahead. Look into getting yourself some silver and gold. So with that, as we always do, saddle up for what's coming ahead, and silver up as well. And I'll see you guys next week. Take care of each other. We're in the same boat all together. Take care.